Okay, so now we're going to go into the very basic stuff of taxes. So we're talking about income coming in, different types of deductions that people are allowed to take, and then we'll also go through what a tax credit is. So this is the schedule that we're going to talk about: income, adjustment to income, itemized deduction, and tax credit. So we'll go through each one in a little bit more detail. Okay, so gross income is pretty much you just add up all the various types of income that people have and you just add it together as your gross income. And the way I like to tell clients is it's like the starting line for the tax return. This is where we actually start on the tax return itself. Okay, so on a tax return, you'll see that different things get broken down. There are different buckets, so you're going to see that I use a lot of buckets in my example. It's one of the things I feel like it's easy to understand for most people. So there are different buckets. There's a wage bucket. So wages is like if you're an employee at a company, or even if you own your own business. That's considered the wage and self-employed income bucket right here. And then there's interest and dividend buckets. So if you put money into a bank or into an investment, it earns money on that, so you pay taxes on interest and dividends. And there's stocks, crypto, and sale of assets. So these are things where you bought something, you paid for it, and then you resell it for a higher price. And then rental is rental, royalties, and K1. This bucket is like if you bought a property, you rent it out to people, or you make an investment somewhere, and then it pays you royalties or K1. And then 401k, IRS, this right here, this is the retirement bucket. So once you retire, all the money that you saved up in certain accounts will be considered retirement income. Okay, so as we go through it, earned, investment, capital, passive, and retirement. Those are the 5 main buckets to be aware of when it comes to the total income that we're adding. Okay, so there are certain things that are not considered income for U.S. taxes. Okay. Gifts and inheritance are not taxable. So if I wanted to gift out anything, even it doesn't have to be relative, it could be to Carl. I could gift him anything and then he won't have to pay taxes on it. Life insurance payouts. So if I had a life insurance policy on a spouse and that spouse dies, the insurance will pay me for that. That's not taxable. Welfare benefits, these are like food stamps where the government helps lower income families. Those aren't taxable. And then certain scholarships for going to college, those aren't taxable as well. Okay, so now that we understand how income works, the next thing is that we talk about deductions. So there's 2 types of deductions. There's going to be something called adjustment to income, which is a section on the tax return. And then there's another section separate from that called Schedule A, which we'll talk about a little later as well. Now, for adjustment to income, this is easy deductions to take. So on the tax return, the client, if they qualify for it, it's easy to take. This one is a little bit harder to take, and we'll go through the details of why it's harder. Okay. So adjustment to income. These are probably the top 9 items when it comes to adjustment to income. And one of the things with adjustment to income is that there's always going to be limits on what could be taken as an adjustment to income. Okay, I'll just kind of go through it really quickly of what those limits are. So when I say limits is that contribution to traditional IRA, this means that if you put money into a certain retirement account, then you could deduct it from your taxes. And we'll go through how all the deductions work a little later. But the main thing I want to take away is that not just anyone can contribute to a traditional IRA and get a tax deduction. This is where the limits come in because it depends on, sometimes it could depend on income limitations, but also the other limitation is that there's a maximum you can put in every year and it goes up every single year. The same thing for contributions to SEP or solo 401k. These are for self-employed individuals. There's limits on how much you could put into that depending on how much profit the business has. If the profit has no business, you're not allowed to contribute into a SEP or solo 401k. But if the company does have a profit, you could take 20% of that profit. Right? So the higher profit, the more you're able to contribute. And then health savings account is another account that's very beneficial, but not everyone qualifies for that. Educator expenses, this is if you're a teacher, teaching from kindergarten to high school, you get like a small deduction if you paid for like school supplies and things like that that wasn't reimbursed by your employers. And then self-employed health insurance, This is the same thing as a solo 401k. If you don't have a profit, you can't deduct self-employed health insurance. You have to have a profit to deduct that. And then student loan interest, this one is based off income. So if your income is too high, then they won't allow it. And the income here, the threshold is actually pretty low. So most people don't really actually deduct this. And then moving expenses the limit here is just, it's only for people in the Army or Navy. Okay, so this is how we'll talk about the calculation when it comes to having deductions versus not having deductions. The first one here, let's just say the income is $50,000 right here. So $50,000, this is considered, say, the total income that they received. And normally, if they didn't have any deductions, they would pay taxes on the full $50,000, right? So let's just times that by 10%, that's $5,000 in taxes that they owe. But if they contribute to a IRA right here, what you do is take the $50,000 minus $6,000. Now you only pay taxes on $44,000, right? So that's where the big tax saving is, because $6,000, that's about a $600 tax saving if they're in a 10% range, right? So now you're only paying taxes from $44,000 only instead of the full $50,000. So by putting money into this traditional IRA account, you do save, say, in this case, $600 in taxes, right? So it's very important that clients understand that by doing certain things, they can actually lower the taxes, or else they'll just pay the full tax on the full $50,000. Okay. So now let's talk about standard deduction versus itemized deduction. So the first part is you could get the deductions as long as you qualify for it, so that's easy. Now for this part, the second part, it's called standard deduction versus itemized deduction. This gets a little bit more complicated because with the US tax system, there's a lot of if, ands, and buts with the system. So you have to make sure that you understand the full scope of what is deductible and why it's deductible, but then also understand the limitations with that as well. So how do we explain standard deduction versus itemized deduction to clients? Like if this client says, hey, I donated $400 to a charity, that should help with my taxes. But unfortunately, that's not so simple when it comes to charity itself, okay? And the way I like to talk about standard deduction and itemized deduction is, the first thing is that you take the higher of the two out of these two baskets right here. So the way the IRS says is that the IRS will give each person 12 apples in the basket. Now, you also get a second basket that's empty. If you're able to fill your own basket up more than 12 apples, then we'll let you keep the 12 apples. But if your apples are less than 12 apples, we'll still give you the full 12 apples. Okay, does that make sense? Yep. Okay, so it's you take the higher of the two. So no matter what, you'll get 12 apples minimum from the IRS, no matter what. Okay, it's just a matter of how many deductions, apples represent deductions, how many deductions go into this basket. Okay, so then it gets a little bit more complicated because you can't just throw any apples into the bucket because there's always going to be limitations. There's going to be a certain amount of apples from, say, the mortgage interest apple tree. There's a charity apple tree. There's a medical apple tree, property tax apple tree, and state income tax apple tree. So these are common deductions for Schedule A. And each tree, you're going to be limited to how many you could put in, right? So sometimes with property tax, even though you might have a full tree full of apples, but you're only allowed to take 2 out of that tree sometimes. Okay, so this is where we have to go through each tree and see how much you could qualify for. So, like say for charity, this one could be 4 apples, and then what we'll do is standard deduction for U.S. taxes is $14,600. So that's the apples that the IRS gives you automatically, is $14,600, and this changes every year. This goes up every single year for inflation. Okay, so the IRS guarantees you to have a deduction of $14,600, and then what you're going to do is $50,000 minus $14,600, then the taxable income is only $35,400. So automatically, instead of paying taxes on $50,000, you're only paying taxes on $35,000 for U.S. side. And then what we want to do is that we could add more deductions. So remember the IRA that we talked about earlier? You could add an extra $7,000 deduction to that. So we're lowering the taxable income even more. That's the whole goal when it comes to US taxes, is trying to figure out, okay, what is the income and how can we lower that income as much as possible by taking certain deductions. That's the whole goal for all clients, right? We want to make sure that this taxable income is as low as possible. So what we do is we tell our clients, okay, we know you're going to get a $14,600 deduction no matter what. But then, if you add an extra $7,000, we're going to lower your taxable income to only $28,400 instead of $35,400. Okay? And the tax difference here is that if you pay taxes on this side right here without the IRA deduction, your tax would be $3,854. But if you got the IRA deduction, you contributed $7,000, your taxes would be $3,215. Right? So that's like a $600 savings or so. So definitely letting clients know that doing certain things can help bring down your taxes. But the thing is, it requires the client to do certain actions to get those deductions. Okay? So now, how do we reduce taxes even more? We talked about there's total income, you're going to minus deductions, and then now we have the taxable amount, but what are we going to do to even reduce the taxes even more? And what we do is we utilize tax credits. So tax credits are better than deductions, okay? Because deductions, if your income is $50,000 and you have a $1,000 deduction, then that means your taxable income is $49,000, right? But tax credit, if you have a $1,000 tax credit, that is actually worth more, because now instead of, let me go through the example. You'll see the example. It'll be easier. So the first thing I want to talk about, there's two different types of tax credits. Okay, there's this section right here, and then this section right here. Now, does anyone know the different types of tax credit? No? The first one is called non-refundable, and the second one is called refundable credit. Okay, and we'll have to go through a little bit more details because this is one of the more complicated parts, trying to explain this to clients. So what we'll do is we'll have examples to help ensure that it's easy to understand. Okay, so let's say for a non-refundable credit, one of it is if you buy an electric car, you get a $7,500 non-refundable credit. So in this case, after taking the standard deduction and contribution, their taxable income is $29,400. So based off of this calculation with the tax bracket, their total tax owed is going to be $3,400 in taxes. Now, we take the credit and we try to apply that. So if they get a $7,500 credit and they owe $3,400, a non-refundable means that it would only cover the balance of the taxes, but cannot bring it down below zero, okay? Because below zero means it's a refund, okay? So meaning that the government is giving back the money. But in this case, $7,500 is way more than this one, but the most they're going to be able to get is only $3,400 credit used, and then they either lose it or sometimes it carries over depending on the type of credit it is. But for non-refundable credit, just know that this will not make it to a point where the government gives an additional refund. So this is a refundable tax credit. So having kids, there is a refundable tax credit where it's I think it's $2,000 per kid. So let's just say there's 2 kids. So this client gets a $4,000 tax credit. Remember, they owe $3,400. So what's going to happen is this $4,000 will go against that, plus an extra $600 that they'll get to utilize. So that means the government's going to give them extra $600 in a refund just out of nowhere, just for having these 2 kids. Okay, so that's what a refundable tax credit means.